advantages and disadvantages of incorporation, and then at what time should you incorporate. And as Eugene mentioned at the end, we'll have some time for questions and answers. So basically, a couple of months ago, October 1st, 2020, I think it was a few years in the making, but there's been some legislative changes, and now real estate professionals are able to carry on their business through a personal real estate corporation. And really the driving force behind this was tax fairness. So, a number of other professionals, lawyers, accountants, can operate their practices through corporations. So real estate professionals should be entitled to the same treatment. And then one really important thing to remember, these corporations have this term personal real estate corporation, and really they're just a standard corporation, just like any other corporation. It's just that they have to meet certain requirements, and if they meet those requirements, then they constitute a personal real estate corporation. So before I get into the terms, I just want to go through those first requirements. So these are the criteria for a corporation to be a personal real estate corporation. So the first thing is that it has to be an Ontario corporation. Usually if you're in Ontario, you can either incorporate under Canadian laws or Ontario. So for these types of entities, it has to be an Ontario corporation. The legislative framework has this concept of a controlling shareholder. So whenever you see a controlling shareholder, basically that means is the real estate professional who's operating this corporation. So some of the requirements, and we'll explain what all of these legal terms are shortly, but the real estate professional, the controlling shareholder, they have to own all of the equity shares of the company. They have to be the sole director, so the only director, and they also have to be the only officer. And that officer has to be a president. That's the title that they have to have. The legislative framework, it also permits the corporation to issue non-equity shares, and those are non-voting shares, but those can only be owned by the real estate professional or their family members. So family members would be spouses, parents, and children. Okay, so I'm going to go back up now, and we'll just get into what some of the key terms, like what do these things mean. So the first thing is a corporation. A corporation is just a legal entity, and an important element of it is that it's separate from its owners. So just as a quick example, if somebody loans money to a corporation and the corporation doesn't pay it back, the lender can't be the shareholder. It's a separate person. And this is something known as limited liability, and that's just basically means that the shareholders are not liable for the debts of the corporation. And there's some exceptions, and we'll get into those shortly. So another important consequence of this idea that a corporation is separate from its owners is that the corporation and the shareholders will file separate tax returns. So because of the separate tax return filing, it creates the opportunity for something called tax deferral, and that's something that we'll also get to later, and that's just basically one of the main benefits of operating through a corporation. So a corporation has shareholders, and the shareholders are obviously the holders of the shares. And we're talking about shares, really what we mean, it's a kind of ownership interest in a company, in a corporation. And different classes of shares basically means that each type of share can have different rights. So common rights that attach to shares are things like the right to vote, the right to receive dividends, which is just a share in the profits of the company, and also a share, if the company ever shuts down, the shareholders have a right to share in its assets. And as we mentioned before, with the personal real estate corporation, the controlling shareholder, which is the real estate professional, they have to own all of the equity shares, which are voting shares. And the real estate professional and also their spouses and certain family members can own those non-equity shares. And when we say non-equity share, we're talking about just a non-voting share. It just basically means that family members don't have a right to control the business of the corporation. So corporations always have at least one director. And a director is the person who's responsible for managing or supervising the management of the corporation. So in the personal real estate corporation context, we can only have one director, and it has to be the real estate professional. And that's just consistent with the idea that it's this real estate professional who has to be controlling the corporation. So officers are very similar, and often they're confused. Their roles are confused with that of directors, but they're basically can be viewed as the senior employees of a corporation. They're responsible for the day-to-day management as opposed to the directors, which are a much higher level of management. And in the personal real estate corporation, we can only have one officer, and it has to be a president. So I'm not going to get into the background and legislation in too much detail, but really the way that this personal real estate corporation fits in is that unless you're registered as a broker or a real estate salesperson under the Real Estate and Business Brokers Act, a person is prohibited from trading in real estate. And trading in real estate, that covers things like selling real estate, leasing real estate, listing properties, those sorts of actions. And the definition itself is even broader, that it covers certain conduct and actions that are in furtherance of a trade of real estate. So it's a pretty broad definition, but it's all tied to sales, leases, and listing property for the most part. So the new change that has been introduced is now a personal real estate corporation can trade in real estate. There are some limitations, and we'll get to that, but the key is that they can engage in some trading in real estate without having to register. And again, as long as they meet the certain requirements. So these are more of like the corporate structure requirements. We went into those, and it's basically this is how you have to structure a corporation in order for it to be a personal real estate corporation. So again, we're dealing with an Ontario corporation, the real estate salesperson, who is the controlling shareholder. They have to own all of the equity shares, which are voting shares. They have to be the sole director, and they have to be the only officer, which is the president. Non-equity shares, which are the non-voting shares, they can be owned by the real estate professional as well as their family members. And also there's a restriction that there can't be an agreement which restricts the power of directors. So basically what this means, very common in standard corporations to have a shareholders agreement. And what a shareholders agreement says is that even though the directors are responsible for managing the corporation, the shareholder agreement will often impose some restrictions. So just for example, it could say something like the directors cannot borrow money unless all of the shareholders agree. So for a personal real estate corporation, we can't have any of those agreements. So the previous list had to do with how you structure a corporation. This list is in order for a personal real estate corporation to basically maintain an exemption from the registration requirements. It basically has to carry on its business in this way. So this is not an extensive list. The list is, it's in the statute, and we can provide that separately, but these are some of the key requirements. So one key is that the controlling shareholder, so the real estate professional, has to be employed by a brokerage. And that doesn't mean that they have to be an employee. They can also be an independent contractor, which I think is generally more common for real estate professionals. Their business of trading real estate. So the personal real estate corporation, they don't have to register, but there are some restrictions in the way that they can carry on the business of trading in real estate. And it's basically, they're almost there to provide services to the real estate professional who's going to actually be selling and listing properties, for example. However, these restrictions this restriction only applies to when the personal real estate corporation is engaging in conduct which would constitute trading in real estate. The personal real estate corporation is free to carry on other businesses. So for example, it can engage in property management services. It could provide, general marketing services, whatever. There's no restrictions on that conduct. These restrictions only apply to the activities it does, which is connected to trading in real estate. So related to this fact that the personal or this requirement that the personal real estate corporation can only really provide its services to the real estate salesperson is that this corporation cannot advertise itself to the public that it's trading real estate. So, you cannot take out a bus ad which, markets this real estate corporation as a, something similar to you'd see for a real estate salesperson. Those kinds of marketing and advertising efforts still have to focus on the real estate professional. Any money that the personal real estate corporation earns from trading real estate can only come from the brokerage, which is similar to a requirement for the real estate professional. And then another requirement is that there has to be a written agreement between the personal real estate corporation, the controlling shareholder, as well as the brokerage. And that would govern the relationship between the parties. And that would deal with things like, how fees are going to be dealt with. So it probably would say something like that any fees on commissions will be paid to the corporation. And then it'll also, for the brokerage's protection, it will probably require the corporation to comply with some of its statutory obligations. And basically, the personal real estate corporation, they have to do things like they just have to confirm that they're going to, ensure that they're going to engage in their conduct in a way that helps ensure that the brokerage as well as the real estate professional carries out their obligations, and that they're not going to obstruct them in any way. Okay, so that's all of the background information about, what are these corporations? What are we talking about? What are some of the requirements? This next section will deal with what are some of the advantages, what are the disadvantages, and at what time should you incorporate a personal real estate corporation. So one of the advantages, and frankly, the tax tax savings and tax planning, those are things which are probably going to be the main, they're the main benefit. They're probably the main reason why you would structure your business using a personal real estate corporation. And then, on a high level, your job is just really to assess whether those benefits are going to be worth the extra, maybe some extra costs and some of the administrative burdens. So I think Eugene will get to this in a little bit more detail, but this whole idea about tax deferral, and this comes back right at the beginning. I mentioned that corporations file separate tax returns to shareholders. So also a corporation can earn income at a different time than its shareholders. So in a simple example, if a corporation, this personal real estate corporation earns income related to some commissions from a sale of real estate, corporation will, generally earn it when it receives the income, and it would pay tax on that income when received. So what's really important about these corporations is that generally in Ontario, they're going to be taxed at a much lower rate of income. So for a small business deduction, so up to $500,000 in income a year is taxed at about a rate of 12.5%, which is probably much lower than any of us pay personally. So the corporation will pay the tax when it earns the income, but the shareholder, that's not the end of the story, unfortunately. The shareholder will ultimately also have to pay tax on that money, but it's not until they actually receive the money. So this idea of tax deferral means that, in very simple terms, is that the company can earn income in 1 year, and it'll pay its lower rate of tax, and then it can hold on to that money. It could hold on to it for 1 year, 2 years, 5 years, 10 years, 20 years. And during that whole period, it's able to use and invest the income that it's earned, and it's only paid a very low rate. And then it can, it earns income off that money. And it's not until that money is eventually paid out to the shareholder by way of probably dividends, but there's other ways that the shareholder will pay tax. Another advantage, and it's related, it's the idea of flexibility of remuneration. So you can choose, as a shareholder of a company, really the controlling shareholder, you can choose when and how to pay yourself. I think in most cases, and Eugene can maybe get into this in a little bit more detail, but generally a shareholder would probably receive dividends because it has some favorable tax treatment. Dividends are generally taxed at a lower rate than normal income. So let's say in that example, there's a really big, you have a really good year as a real estate salesperson, and you're operating one of these corporations. You have a really good year with a really high level of income. Instead of just paying that all out to yourself as a shareholder in 1 year, what you can do is split it up over 3 years. And by doing that, there's a possibility, it depends on the other income you earn, but all else being equal, if you pay yourself, let's just say $100,000 over 3 years, so $33,000 and change each year, you're going to pay a lower overall tax rate than you would if you paid yourself $100,000 in 1 year. So that's another advantage of using a corporation. You can time when to pay yourself. So other advantages, I got into this before, it's that when you're operating a corporation, you'll benefit from limited liability. So you're not going to be responsible for the debts and liabilities of the corporation. So there are some restrictions. One is that from a professional standpoint, you're not going to be able to push off your professional obligations on this corporation. You're going to be responsible for all of your regulatory and professional requirements. There are also what are called statutory liabilities. So remember that the real estate professional has to act as a director. So there's certain situations where there's laws that basically say when a director will be liable for the debts of the corporation. And some of the main examples are, they're generally tax related. And just as an example, if the company collects HST and doesn't pay it to the CRA or deducts the employee withholdings from their employees, so income tax and Canada pension plan and employment insurance deductions. If the corporation takes these amounts and then doesn't pay it to the CRA and then goes bankrupt or whatever, the director can be liable for those things. Also, is if a shareholder provides a personal guarantee, well, obviously you've just defeated the benefit of limited liability. So a common example, where I'm sure most of you are very familiar with, is if the corporation is going to enter into a lease with a landlord. In many cases, the landlord wants somebody else to act as an indemnifier or a guarantor, where basically they'll have you be personally liable for the lease obligations. Another benefit of a personal real estate corporation is succession planning. And this is basically, it involves a number of different concepts, but what we're talking about is when a professional is winding down their involvement in a business. And so that could be through a sale to a third party or even transitioning their business to a child. That can be done in an orderly way through a corporation. And one of the benefits to that, and this will come up when the shares of a company can be sold to a third party, there are a number of requirements that have to be met, but on a general level, small corporations that are operated, the shareholders benefit from what's called the lifetime capital gains exemption. And there's basically a certain amount of money, a certain amount of capital gains that somebody could earn without having to pay tax on those gains. Eugene, you can confirm the number. I think it's about $800,000 right at this time. It changes from time to time. And then another advantage is tax splitting. And this is a bit of a mindful. You have to be very careful when it comes to tax splitting. And this is one of the areas where you would always get advice from an accountant before engaging in the tax splitting, or you should anyways. But basically what that involves is, this is similar to the concept I discussed before, where if you earn $100,000, you can pay it to yourself in 1 year and you'll probably pay a higher rate of tax, or you can phase it out and pay it to yourself as a shareholder over 3 years. And because you're earning a lower amount of tax in each year, you're going to overall pay a lower rate of tax, or a total amount of tax. You can do the same thing with spouses and children. Eugene, you're going to get into, I think, some of the details, but basically some of the restrictions is salaries that are paid to spouses and children, it has to be a fair value for the work that they've done. So you can pay a child as much as they would probably like it, $50,000 if they're coming in once a week to do a bit of administrative work. And then when it comes to paying dividends, so number one, they have to be shareholders to receive dividends. There are restrictions on children. Generally speaking, you can't pay dividends to a child who's under 18, so it has to be adult children only. And they have to have some involvement in the business. Eugene, you want to take over from here?
Yes, let me unmute myself. We can go from here. Yeah.
Okay.
If you can leave the slides on so we don't switch them.
Sure.
If you don't mind, I'll ask you to when I'm ready to go to next one. Okay, income splitting rules. There was a legislation a few years ago which has limited the way you guys can split the income with your spouses and adult children. And all of this has to be done extremely carefully because the dividends can only be split when the relatives are also share in the ownership of the company. Okay, if the spouses are also real estate professionals and the owners of the company, the dividends can be issued to them. If the spouses and children are not the owners of the corporation, then the income has to be split through the salary, and the salary has to be at fair value, and the services actually has to be provided. The attribution rules, which CRA has introduced 2 years ago, are quite punitive, and making a mistake in splitting the income will result in very, very high penalties. So all of this has to be done with the help of your accountant. The other part of this, the income splitting, if the corporation in a few years makes quite a bit of money and capital of the corporation grows and the company decides to invest into, for example, real estate or into shares in a stock market, and during the transfer of that property and assets to children, there might be an issue coming up with the transfer of those property to the minors and the family members. So all of that has to be taken care of in most careful manner. So everything has to be valued at the market rate. If it's being transferred at lower than market rate, that will create an issue for the corporation. The other transfer which you have to understand, if there are assets which real estate professionals own at this point and would like to transfer to the corporation, you have to look into transfer with your accountant, and your accountant will be able to transfer those assets on the most tax advantageous way. Can you please switch the slide? Now, what are the disadvantages of real estate corporation? Number one, there will be the accounting cost obviously will go higher up, but not significantly. We are servicing quite a few real estate agents, and what we notice that the most important part of any real estate agent is taking care of their bookkeeping situation throughout the year to anticipate the tax costs such as HST and personal taxation. If that is not anticipated, then the big tax hit usually comes in as a surprise to real estate agents. And in April of the following year or June following year, they are hit with a very large tax bill. So the routine bookkeeping is a key to ensure that there are no surprises during the after the taxes tax return situation. So bookkeeping in reality will remain the same. However, the bookkeeping becomes a little bit different than the bookkeeping for the self-employed individual. CRA requires that the accounts have to be reconciled and kept for the corporation in more strict way, even though we're doing the same work, but the way we're presenting it is a little bit different. On top of everything, there is a cost of filing corporate tax, which will probably bring the the cost of your tax return by higher by at least 40 to 50%. There are legal costs associated with registration and possibly annual minutes and resolutions. So that has to be all looked into. So what we usually propose to our clients is employ the technology. Employ the technology as much as you can. Sign up with one of the software providers, cloud software providers online, like QuickBook Online or Xero or Wave, and try to automate your bookkeeping as much as possible to reduce the cost of the bookkeeping and accounting. That's the bookkeeping portion. With the tax return, you can't really do too much of reducing the tax bill. So that's the additional cost which you will have to endure. You might have to get additional insurance policy. And what also very important, that the contracts between your brokerage have to be done very carefully and insulate the PREC from the liability which involve in the conducting the real estate business. Next, please. Now, when should you incorporate? Generally, we suggest you incorporate once you understand what your total income is within your self-employment business. People usually ask me the question like, how much should I earn to think about incorporation? And I always answer that it's not how much you earn, but how much is saved after you pay the taxes and what's in your pocket at the end of the year. The reason why I'm saying that is because if your total expenses to go month to month on in the household, and I'll give you the examples, is 50,000 months, and that's what you have to draw. If you, in order to draw 50,000, you realistically have to make 100,000 as a self-employed. In a corporation, you don't have to make that much. You can make less than that. You can split the income and keep the difference within the corporation. The money which will remain in corporation can be reinvested later. So once you feel that you're making more than you need for your monthly household expenses, that's when you should look into the incorporation. We say that incorporation sooner usually better. And the reason for that generally is because when your self-employment business grows very high, it's much more expensive to incorporate. However, with real estate agents, this situation is rare because they usually do not acquire any assets during their operations. Therefore, the transfer of this asset is not an issue. Hence, the general rule, yes, the sooner the better, but you still have to rely on your household expenses, what you need to draw in order to provide to your family. Now, about the profit which requires for incorporation, the last point probably is in relation to the same example of 50,000. You would think that on 50,000 it will cost you extra $800, $1,200 to do the accounting and do the legal resolutions annually, so and so. But in order for, if you saving 20% of that 100,000 in taxes, that gives you a big advantage if you incorporate rather sooner than later. Next, please. Now, questions and answers. I just reviewed the Q&A in the system and I don't see anybody asking anything. So I would suggest that you unmute yourself one by one and maybe will raise your hand. And if you would like to ask a question, we'll unmute you and you can ask the questions. Okay, Walid just asked, what is the additional insurance? Now, if the additional insurance generally will not be asked from in terms of the corporation, however, you would have to contact the people who's insuring you. I think you're paying your insurance through Ontario Real Estate Association. From what we know so far, there might be a slight increase and they will command that increase for you.
Yeah, and the other thing I was thinking, Eugene, also is it depends on the business that the corporation is carrying on, but especially if it's carrying on different businesses, sometimes it would, might at least consider a separate commercial liability policy, but that's something to speak with an insurance agent about.
Yeah, or if you're going to rent a space, you might look into insuring that space.
Yeah.
Okay, another question submitted online. Investing opportunity. Is a real estate corporation able to invest with the money remained in a corporation, or it's only allowed to conduct day-to-day real estate activity? Jonathan, would you like to?
So the short answer is yes. There's no restriction on the type of activities that the personal real estate corporation can do. It's just that list that we went through of restrictions, about marketing. Those only apply for its trading real estate activities. So you could have a personal real estate corporation that helps a real estate business, and for one reason or another, often you would use a separate company, but let's just say for whatever reason you want to keep using the same corporation, you can use that corporation to invest the excess money. You can use it to purchase a property as an investment property and rent that out. You could operate a separate property management business using the same corporation. Yeah, so short answer about investments is, yeah, you can reinvest the money.
Okay.
And then Eugene, with the for corporations, when they reinvest, when they have investment income, they do pay the higher rate of tax, right? It's at a higher rate.
It's dependent on a ratio of investment income and the operating income.
Okay.
So that tax will go higher if the company becomes an inactive corporation, basically acting only as a holding for the investments. Doesn't matter which one, whether these assets are in real estate or in a stock market. That usually happens when the owner of the corporation is retiring, or in semi-retirement stage, when the operating activity are drastically reduced. Otherwise, everything is being taxed at the same rate, around 12-13% in Ontario. Okay, I think Walid just asked one more question. Do we have to set up a new separate bank account for the corporation? Yes, you have to set up a separate bank account for the corporation because the corporation is a separate legal entity and it requires its own bank account.
Yeah, I think in short, if you're commingling the company's assets with your own assets, but basically you're using one bank account and all of the corporation's income is going to that account, and it's your personal account and you're paying company expenses. You're basically increasing your chance. You're eliminating your limited liability benefits for the company. Now a creditor or a debtor can sue you personally because you can't separate the company's assets from your own. And I think there are a fair way to say it might be there could be some tax complications because of that.
Okay. Anyone else? All right. If everything is quiet and nobody is asking any more questions, I would like to let you know that if you would like to have the slides emailed to you, please send us a request. We'll email you the slides. Also, the recording of this seminar will be published on YouTube, and we'll send you the link to the video, and we'll publish it on Facebook and LinkedIn. Okay. Thank you so much for attending this seminar, and we'll see you soon.
Thanks, everyone.